We hear you.
Good, and we can hear you.
Excellent, excellent. Thank you, everyone. Appreciate everyone joining. This is again Alok Modi with Pillars of Wall Street. Welcome to the M&A Accounting webinar. Does anyone have any questions on anything up to now? So up to this point, anything that you've covered with Pillars with us this spring, does anyone have any questions on any of the content thus far? Perfect. So let's get started here. So today's session, we're going to be focusing on M&A accounting. So the idea here is we're ramping up our accounting knowledge and taking things to the next level. So essentially, until now, you've been focusing primarily on the three financial statements, understanding what's on the income statement, balance sheet, and cash flow statement, as well as, of course, the interrelationships between the three statements. Now, what we're going to be progressing to is focusing in on M&A accounting. So accounting as it pertains to acquisitions and how to account for buying a stake in another company, okay, whether that stake is 20%, 40%, or majority north of 50%, which requires consolidation. How do you account for that? So that's really the goal here, the focus today, the objective of what we're doing here today. Okay, so let's get started here now. And the other thing I would encourage everyone to do is please, throughout the session, make sure that you guys are asking questions as well. If you have any, that's actually really important. We always encourage that, as you know. Please reach out and just ask questions if you have any on any of the concepts, the topics, even if it's something unrelated. Just feel free to ask. Right, it's very important to us to make sure that you guys are getting your questions answered, if that makes sense. So let's turn here to page 3. And before we get into any of the math here, focus in on why companies invest. So a few reasons. A, it's the nature of their business. When you think of hedge funds, private equity funds, VC funds, pension funds, right? These are the kinds of companies that invest because that's what they do, right? That's the nature of their business. That's how they make money. That's the goal of what the firm is all about, right? They're all about investing. That's the nature of their business. So that's essentially the first point. Okay, the second point here. So A, nature of their business. B, put idle cash to work. Well, a lot of companies, just think these days, companies like Microsoft, Apple, right? They have a ton of cash sitting idle, to the tune of 100 billion plus in cash and investments, just sitting there on the balance sheet. Well, if they don't actually need that cash immediately to pay off loans or to fund operations, and let's be honest, a company like Microsoft or Apple, they don't need that idle cash to fund operations. They have a constant influx of operating cash flow on a day-to-day basis, right? On a quarter-to-quarter, year-to-year basis, they have a ton of excess cash flow from operations via their operations, right? So therefore, they don't need the excess cash sitting on the balance sheet to actually conduct operations, pay employees, pay off loans, invest in CapEx, things like this. So they can take that cash and earn a return by putting it to work. This would be a short-term investments, investing in other companies, things like that. So that's the second reason here why companies invest. Third, to gain influence but not control over another company. So now that's getting into equity method investment territory, and we're going to discuss that as well. So essentially, the buyer seeks to increase their presence within that industry, seeks to gain influence over another company while not achieving total control. Okay, so we're going to talk about that as well, and that's known as an equity method investment, where you have real influence but not actual control, meaning you're not actually dictating their day-to-day operations, and you don't have a say in the company matters at the end of the day. D, to gain control, and this is really what the focus is here today. to become a majority shareholder, a majority controller in another company. So effectively, if I buy 51% or more of another company, and assuming economic control equates to voting control, we're going to get into this a bit, but this is where it gets a bit tricky, because just because I buy 51% of the shares does not necessarily mean I can control the majority of the operations, because it depends on the voting nature of my shares. Okay, this is where you tend to get a bit granular, and it's not black and white, because think about a company like Facebook. Think about a company like Snapchat or Google, where the founders, they essentially have supermajority voting rights, as it's known, because each of their shares may have 10-to-1 voting rights. So therefore, if you're one of those owners, well, even if you only own 20-30% of the shares, you still have majority voting control, because your shares, each share has something like 10-to-1 voting power, right? As opposed to an ordinary share, which you and I might buy, which only has 1 vote per share. They might have 10 votes per share. So when you start to get into that sort of granularity, it's not black and white. But the bottom line is, we're going to assume for today that a 51% stake, economically speaking, equates to a 51% stake voting-wise speaking. So in that sense, if you buy 51% or more of a company's shares, you essentially have voting control. And that's what we mean by gaining control at the end of the last bullet. Okay, and that's the focus of today, where you actually buy a company to gain control and to dictate decision-making power, if that makes sense. Okay, so that's the focus here. And if you think about it from an M&A perspective, that's really, in most cases, where you are, right? You're in that spot where you're dictating control, right? If you're advising from an M&A perspective, a client on acquiring control, on buying another company, or even on the, let's say, sell side, selling the entire company, what you're doing is you're advising from a control perspective. So that's really where the consolidation process comes into play, and it's the focus of today. Okay, so let's get going here. Now, M&A accounting overview, we have a few different options here. We have 4 different types of accounting. Full consolidation, which is really known as acquisition accounting, formerly purchase accounting, same thing. We have equity method accounting, JV accounting, and fair value accounting. Now, what we're going to be, again, focused on is full consolidation, where you acquire more than 50% of a company, in which case the company that you buy is known as a subsidiary, okay, because it's now consolidated into the parent company, and the parent company owns that subsidiary. Okay, and in that case, effective control has been achieved. The second line here, equity method accounting, arises when you buy 20 to 50% of a firm, in which case significant influence but not management control has been achieved. That's known as an equity method investment or an equity affiliate. Okay. The last one we're not going to spend a ton of time on, but the idea there is if you share control with another party and you own more than 50% of a company, but in conjunction with one or more other parties, that's JV accounting. And finally, if you buy less than 20%, that's fair value accounting. In that case, there's no control. You're just investing for capital appreciation and potential dividends, and that's a financial investment. Now, we alluded to this earlier. Keep in mind that control and significant influence are not always straightforward. So you often look at ownership percentages, and this is what we mean by economic interest, like we said earlier. But if you buy, let's say, 51% of a company, does that really mean you consolidate? If you buy 20 to 50%, does that really mean it's an equity method investment? Well, not necessarily, right? So look at the bottom. Consider the following situations. Let's say, and these are actual instances. International Paper owned 13% in Satex Corporation, but accounted for this using the equity method. You might say, but wait a second, I thought we just said 13% is a financial investment. So why equity method? I thought that's reserved for 20 to 50%. Well, yes, but in this case, International Paper, right, they cited their ability to exercise significant influence because they were a party to a share owners agreement with two other entities, and together they owned over 39%, and 39% falls into that 20 to 50% band, right? So again, that's the kind of thing where you have to really get into the details. If you own a small percentage, 10, 15%, but it's in conjunction with other parties, well, together you might have significant influence. The second example, prior to the acquisition of Bell South, AT&T owned a 60% stake in Singular. You might think, again, 60%, okay, well, that must be a consolidation, right? Majority acquisition. But no, that was also an equity method investment. Not full consolidation. Why? The idea there is that they're sharing control equally with their 40% partner, Bell South. So because they share control equally, right, they don't actually have majority control on their own. They're going to say equity method investment. They have significant influence, but not total control because they control Bell South, right? They control the company in conjunction with the other entity. Okay, questions on this?
The international paper one is not.
I think there's an echo here on the line.
Can you hear me?
There's a bit of an echo. Make sure that there's no background noise. Make sure that if you're speaking up, there's no background effect or noise or anything. Okay, and any questions up until this point?
No, no question.
Is my audio still messed up?
I think there's a lot of echo here coming, whoever's speaking here. Okay, so let's keep going here. So now, in terms of the full consolidation process, that's what we're focused on here. We're going to assume a threshold of more than 50%. Now, what we said earlier is this is known as acquisition accounting, in which the controlling company is the parent and the target is the subsidiary. Right now, let's say that more than 50 but less than 100 is acquired. Well, the part of the subsidiary we do not acquire is actually known as something called NCI, non-controlling interest, or formerly called minority interest, something that you might have seen before in terms of the term minority interest. Same thing as non-controlling interest, or NCI. Okay, so if you buy more than 50 but less than 100%. First, we're going to focus solely on the 100% acquisition scenario, but then eventually we're going to get into the NCI consolidation scenario as well, where NCI arises. Now, let's start with the acquisition of 100% of the target. So first, before you perform the consolidation process, what you want to do is calculate goodwill. Okay, so how do you calculate goodwill? I'm sure many of you have heard of the term goodwill, but essentially what that means is what's the purchase price for the entire target company, 100% of the target, minus the fair market value of the net assets acquired. Essentially, when you take that difference, you have deal goodwill. Now, this is where you really got to keep track of the math, right? Where we see people mess up all the time. Frankly, even when I was back in my days in M&A at Jefferies, when I used to, give the problems, and not just problems, but models and assignments to analysts and interns, where people used to mess up a lot is the details, right? The big picture, everyone can memorize definitions, but it's the details and all of that where people used to really get messed up. And that's where you have to pay attention. So when we say less fair value of net assets acquired, what we actually mean is take the book value of the assets minus liabilities or equity, gross them up to fair value, and then what you actually have to do mathematically is subtract the target goodwill, the existing target goodwill. And what the purchase price minus the fair the fair market value of the net assets acquired less existing target goodwill leads to is the deal goodwill. So the deal goodwill includes target goodwill. Okay, so mathematically, because you subtract the fair market value of the net assets acquired less existing target goodwill, what the deal goodwill figure includes is the target goodwill. So mathematically, that's important to understand. Okay, because the deal goodwill includes target goodwill. Again, we're going to see all the math here in a bit when we go through an example. Okay, now any excess purchase price paid above the fair value, that's essentially deal goodwill, and that's really what we're getting at here. Okay, so if you're paying more than the fair value of the net assets you acquire, well, that's what we're going to attribute to deal goodwill. Okay, so you can look at deal goodwill as the the unallocable portion of the excess purchase price. That's another way of looking at the concept of deal goodwill. It's the unallocable portion of the excess purchase price. Okay, let's actually go through some examples. I mean, it's one thing just talking through all this verbally, but of course, it's much easier when you go through the math and the example. So that's what we're going to be doing with you here mostly. We're going to be going through examples throughout. So here's the first one. Red buys 100% of blue for $300 million, assuming everything is in millions, right? Just to be more realistic. Of course, not $300, but $300 million. Finance with 50% debt and 50% equity. Now calculate the deal goodwill and construct a pro forma balance sheet. Okay, so how do we do this? Well, the first thing you want to do is understand the steps, right? So here are the steps. The first thing is fair value adjustments to target balance sheet. Well, there are none in this case. There's no fair value adjustments. If you had them, then you would step up the PP&E and or intangibles, but we do not have them here. So the next thing to do is calculate deal goodwill. Remembering, like we said before, to zero out the target goodwill. Then include the adjustments for how you are financing the deal. Are you paying with acquire cash, raising debt, or issuing equity? What are you doing? Right? Include that. Then zero out target shareholders' equity. Anytime you buy a company, you have to keep in mind that you are buying out the net assets of the firm, the equity, and therefore you need to zap out the target shareholders' equity. Finally, consolidate, meaning add up the acquire and the target balance sheets line by line. Let's go for an example. Right, so the one we just went through. Well, the first thing to understand is there's no fair value adjustments in the example we just went through, right, that we just introduced. So there's no fair value adjustments. If there were, you would incorporate the step-ups. But there are none. And as a banker, right, if you're in corporate finance and banking and private equity in these industries, it's not your job to figure out what the appraisal is, right, what the actual fair value is in detail. That's what the accountants come in and do once the transaction closes. But for illustrative purposes, when modeling, you typically assume 20-30%. That's what I did in banking, right? Back in my days in M&A, I just assumed 20%, 30% step up for PP&E for intangibles, and hey, no one bothered me about that because that's a fair value. And what's someone going to say? Oh, it should be 36.8%. Nobody knows, right? Initially, you have no idea. When the transaction closes, that's when the accountants and the appraisers jump in and figure it out. So initially, when modeling, you make an assumption, something like 20, 30, 40% step up, call it a day. Okay, and that's a step up again to PP&E or intangibles.
Hello.
Now, given we have no step ups, yep. Question here.
Can you hear me now?
Yep, I can hear you. Hi, Jamie.
Okay, perfect.
How are you?
Okay, so because there's in fair market value, no matter whether it's like a stock deal or an stock sale or asset sale, there's not gonna be any like deferred taxes creation.
Excellent question. So that's getting really into the weeds, but that's an excellent point. If you actually have an equity deal and you have a step up, then that will result in a deferred tax liability. So That's an excellent point. And yes, if you are modeling out an equity deal and you have a step up, that will actually, from an M&A point of view, result in a deferred tax liability. Yes, that's correct. If you have an asset deal, that's a different story, right? Because then you're actually recognizing the step up both for GAAP and for tax purposes. So a deferred tax liability arises when you have a differential in the step up or the basis for an asset for GAAP and for tax purposes. So because in the case of an equity deal, you're recognizing the step up for GAAP purposes, but not for tax purposes. In an asset deal, you do, but not for GAAP, not for an equity deal for tax purposes. That's going to result in a deferred tax liability, actually, the step up. So you are correct. Yeah, that's an excellent point. So we're not getting into all that weeds, all those weeds today here, but that is correct. In the case of an M&A model, you do have to incorporate the deferred tax liability if you are modeling a step up in the context of an equity deal. So yes, that is correct. And what's going to happen is then you model out that deferred tax liability, and then over time, right? Over time, that liability will unwind as you end up paying off that tax liability, right? The DTL arises because you have a liability. You essentially owe more to the government of expense, and therefore, over time, as you pay off that liability, the DTL unwinds. Okay, so this is the sort of detailed stuff we get into in our M&A modeling courses. At the moment, we're just we're focusing more just big picture on the M&A accounting, but yeah, that's actually an excellent point, and it is something that we do get into in our detailed M&A modeling courses, modeling out the DTL and things like this. But yeah, that does arise in the context of an equity deal when you have a step up. Yep. Okay, questions here. Okay, Jamie, does that help? Just want to make sure that that's clear.
Yeah. Thank you so much.
No, of course. Just want to make sure if you guys have questions. That's an excellent question. Just want to make sure if you guys have questions, you're getting them answered. But yeah, so just something to know for everyone there. Yep, perfect.
Hey, is the step up basically a premium that you're paying on certain assets or equity, or can you just explain that a little bit more, please?
Yep, Jaden. So good question. So basically, a step up means that what you're going to be paying, right, accounts for the fact that the market value of the assets you're buying is higher than the book value. So what's a good example? Let's say you buy a company and on the balance sheet, the PP&E is worth $100 million. Well, I might be willing to pay $200 million. Why? Because the book value of that PP&E, right, that's on a historical basis. Let's say a company bought a building back in 1990. That building might be worth $10 million on the balance sheet. But you know what? In reality, hey, it's 30 years later. The market value might be worth 30 million instead of 10 million. Well, on the balance sheet, it's still going to reflect 10 million. But in reality, it's worth 30 million, right? So if you buy the company, well, the 10 million is not relevant anymore. All that matters is the 30 million, right? So that's the way you want to look at it. Hey, what's the market value of that asset, right? That's what you're going to be willing to pay for it. And frankly, that's what the seller is going to care about. Imagine you were the seller, right? And you bought a building back in 1990 for 10 million, and today it's worth 30, and you want to sell your company. Are you going to care about the 10 million that you paid back in 1990? I mean, frankly, maybe you bought it in 1940 for 2 million. Is that really relevant anymore? No, what's relevant is the fact that today it's worth 30 million, right, given the current market. So that's really all that matters. When you sell the company, what you really care about is the market values of your assets and liabilities, not the book values and not the historical cost. So that's the way you want to think about M&A in general, right? What's the current value, the market value, not historical. Okay, questions here. So hopefully that helps. Let me know if you have any questions here on that. Okay, perfect. So deal goodwill. Let's calculate it. Well, what's the purchase price? 300 million, right? That's what we said a couple slides ago on page 10. We said buy for 300 million. Okay, so what's the purchase price? 300 million. What's the target net assets? What are they worth? 250 million, right? You saw that on page 10 as well, the equity. By net assets, we mean assets minus liabilities or equity, right? So just jump to equity for blue, 250. What's blue's goodwill? You see that's 40, right? So remember we said you have to actually zero out the target goodwill. Subtract the 40 and we get 210. What's 300 minus 210? 90. So therefore the deal goodwill is 90. And that is inclusive of the 40 in target goodwill. Any questions on this? So the deal goodwill is 90, which is inclusive of the target goodwill of 40. Keep in mind that for public companies, we do not amortize goodwill or indefinite life intangibles like brands anymore. Okay, but rather we test them annually for impairment, just like any other indefinite life PP&E or intangible asset, right? Like land or brands, anything like this. But there's a little note here at the bottom as well that says U.S. private companies have the option to amortize goodwill over 10 years. Just something to keep in mind. So therefore, on the next page, we're elaborating a bit more, but not reading every bullet here. But the bottom line is, hey, if you're dealing with a private company, there was a rule that came about like 7 years ago that said that if you are dealing with a private company, you know, just keep in mind that they could amortize goodwill over 10 years. But they have to keep in mind that if they get acquired by a public company, you might have to discontinue the elimination. Okay, so again, just little points like this to keep in mind if you are dealing with the private company that is amortizing goodwill. Any questions here at all? Just let me know. Any questions at all?
Yeah, I have one. Where did you get the 250 and the 40 from again?
Yeah, perfect. So 250 and 40, go to page 10. So the 250 is going to be Blue's equity and the 40 is Blue's goodwill. Look in the blue column.
Got it. Thank you.
Yep, because when we say net assets, we mean assets minus liabilities or equity. So the equity is 250, and that basically means all of the assets for Blue minus the liabilities. So what's liabilities here? It looks like 160, right? 60 plus 100 for Blue. So 410 minus the 160, that's 250. So the easier way of doing it is just going to the equity for Blue and saying that's the net assets. Okay, questions here? Okay, perfect. So let's keep going here now. What does the consolidated balance sheet look like? I'm going to give everyone a second here, second meaning like a minute. And this is the kind of thing where it's better to just take the time. This is really how you learn best, by attempting the problem and then going over as a group rather than just looking at the answer. Look at page 15. See if you can come up with the consolidated balance sheet on its own, on your own for red. Now, just something to keep in mind. You might be wondering, hey, what's financing? Hey, what's accounting? What's the difference? But the easy way of looking at it in any M&A, in any acquisition context, whether it's M&A or LBO, is financing is the new, accounting is the old. Again, financing is the new, accounting is the old. So what is the new financing? How are you funding the deal? Are you paying cash, issuing debt, issuing equity, right? That's the financing. What's the accounting? That's what you're removing, right? You get rid of the old equity. Okay, maybe there's a goodwill adjustment, right? Things like this. So that's the old. Now, what we always say is don't get too bogged up on the financing versus accounting. What's the most important thing? That your Red Corp consolidated, that your consolidated entity balance sheet is correct, and that the consolidated balance sheet balances. That's the most important thing. If you accidentally, put one thing instead of financing in the accounting column, or vice versa, is that the end of the world? No. What's the most important thing again? That the consolidated column is correct. That's really what matters at the end of the day, if that makes sense. Okay, so I'll give you guys a minute. Go ahead, see if you can fill this in, and then we'll go through it. Page 15. Any questions here as you guys are going through? Okay, so let's start to go through. Now you see what's going on here. You have goodwill of 90, which we discussed earlier. You have to back out the impact of the 40 in the accounting column, right? So you see how we have 90 and then minus 40 for accounting. That means that because the 90 is inclusive of the 40, as we discussed, you have to back out the 40, otherwise you won't balance. Right now, when you add across each row, you end up with the total assets and liabilities and equity number of 1760. If you did not subtract out the 40 in the accounting column for goodwill, you would actually end up with 1800 for total assets, right? Well, now you're not balancing. So it's really important to going through and not just memorize, right? Because the 90 includes the 40, you have to back out the 40 in the accounting column so that you're not incorporating the goodwill of blue twice, right? Otherwise, you're double counting blue's goodwill, right? The 90 already includes blue's goodwill. If you don't subtract it, well, you're including blue's goodwill twice because the red corp consolidated column is the sum of the other four columns. To be consistent, always think about it from an Excel point of view, right? When you're modeling, you have to make sure that the formulas are not different in every row in the red corp consolidated column. So because every formula is the sum of the first four columns, what do you have to do in the adjustments to get the right consolidated figure? You have to add the 90, but then subtract the 40. Okay, and then you end up with 1760 on both sides. And on the liabilities and equity side, you have to include the financing of 150 for debt and equity, and then back out the 250 for equity. Any questions here on page 16?
Hello?
Yep, hi, how are you?
Hi. Can you remind me where the 90 comes from?
Yep, so the 90 is going to come from the goodwill calculation on page 13. That's the purchase price minus the target net assets excluding goodwill.
Perfect. Got it. Thank you.
Yep, no, of course. So remember, you have to include the 90, but then subtract the 40 because the 90 includes the 40. Okay, so now, how do you consolidate the income statement? We have to factor in synergies, whether it's, meaning incremental revenue or cost savings. Synergies meaning what? It's beneficial, right? Synergies means there's an increase in profit due to higher revenue and or decreased costs. If there's any step-ups, you have to expense the incremental DNA. And then finally, you have interest expense from new debt and any lost interest income from existing cash. Okay, so these are the adjustments. And then, of course, as it says in step 4, you have to include the tax impact of all of those items using the applicable MTR, marginal tax rate, right? Because those are all subject to tax. So let's do an example. Expected SG&A synergies of 35 million, new debt interest rate of 8%, MTR 35%. What does the pro forma income statement look like? Well, we gave you a setup here on page 19. I want you to give it a shot. I'll give you a minute. Think through carefully what the consolidated income statement looks like. Okay, so go ahead, go through the adjustments here. And then once you have the adjustments done, figure out the tax expense, right? The resulting tax expense adjustment. And then calculate the consolidated Red Corp line items there. Okay, so go, I'll give you a minute. Fill in page 19. All right, let's go through. So what do the adjustments look like? The interest expense adjustment is 8% times 150, which is 12, right? We had 150 million in debt. Then the tax expense adjustment is the 35 in synergies less the 12 in interest times the 35 MTR, which is 8 million. Now keep in mind that the SG&A synergies result in, if you have synergies, that means that's positive, right? That's essentially an increase in profits. So if costs go down, SG&A goes down. You see that the consolidated SG&A is 290. That's 250 plus 75 minus 35. So SG&A went down, which means profits go up, which means taxes go up. So that's going to result in a higher tax figure. The interest expense results in a lower tax figure because if I have more interest expense, I have lower profits and therefore lower taxes. So therefore, because the 35 is higher than the 12, the net result is that the tax expense actually goes up. If by 35 minus 12, you take that and then multiply it by 35%. So that's how you get the positive 8, meaning tax expense goes up by 8. Any questions on the math here on page 20?
Yeah, I have a question. I'm confused how you got where for the incremental interest expense, where did the 150 come from that you multiplied the 8% by?
Yep. So the 150 is how we're funding the deal. So on page, let's see here, on page 10, we're saying that red buys 100% of blue for 300, financed with 50% debt, 50% equity. So 50% of 300 is 150 debt and 150 equity. So that's how we're funding the deal on page 10.
Okay,
So
that
it's
makes
the same problem essentially. Yeah. So it's the same problem. So that's the other thing to keep in mind, that throughout the section, it's the same problem. So we're funding a 300 purchase price with 50% debt and 50% equity.
And where does the 35 come from?
The 35 SG&A or 35 tax rate?
35 minus 12.
Yep, so that 35 is the SG&A synergies from page 18. We're saying there's expected SG&A synergies of 35 million.
So any like changes in like synergies or expenses, you take the opposite of it, like the negative, and subtract the other ones?
Well, I wouldn't memorize that. You have to ask yourself whether that actually increases or decreases taxes. If I have more SG&A synergies, or actually any synergies, increase revenue or decrease costs, does that increase or decrease profits? So if I have more synergies, right, that means it's beneficial. Does that increase or decrease profits?
That decrease profits.
So if I have less costs, does that decrease profits or increase profits?
Sorry, increases.
Increases. If I have more profits, then does that increase or decrease taxes?
Then that increases taxes as well.
Exactly. So that's why you have a positive 35. Now the minus 12, because if you think about it, if I have more debt, I have more interest. If I have more interest expense, does that decrease or increase profits?
Decreases.
Yep. And if I have less profits, what does that do to taxes?
Less profit, less taxes.
Exactly. Very good. So that's exactly why you have to have positive 35 and minus 12. So I wouldn't memorize. I would just walk through each adjustment step by step, and then think about it like, hey, does this increase profits? Okay, so what does that do to taxes? Look at it from that point of view. So that's why we have a positive 35 and a minus 12. Okay, questions here?
Got it. And why is it marginal tax rate and not effective tax rate?
Yep, so you always want to use marginal because you're adjusting the incremental amount. Look at it like effective is the average tax rate, right? So if I said, hey, what's this tax, what's the tax rate for the company overall? And you're projecting out tax expense in a model, you want to use the effective because that's the average tax expense divided by profit before tax across all of your income, right? But the marginal applies to the next dollar of income or expense, technically, right? So if I earn $1 more of income or $1 less of income or $1 more of expense, what does that do to tax? Well, then you want to apply the marginal. So because here we're not dealing with the average tax rate for the firm, we're dealing with just the incremental tax expense, either higher or lower, just the incremental. That's why you want to use the marginal here. The effective would be used if you want to model out the tax expense, right, as a percentage of the profits before taxes. So an average tax rate for the firm, that's effective. Marginal is the incremental, if that makes sense. Okay, questions here on page 20. Okay, so now we're going into acquisition of more than 50 but less than 100% of the target. In this case, what did we say before? Non-controlling interest arises, NCI. Okay, so non-controlling interest or NCI arises when you buy more than 50 but less than 100% of a company. Okay, so keep in mind that this used to be called the NCI, used to be called minority interest. Now it's NCI, but some people might still call it minority interest. It's the same thing. The NCI just reflects the economic reality, and it's more clear, right? When you say minority interest, it's not as clear. When you say non-controlling interest, it really reflects what's going on. That's an interest that the parent company, right? The parent company owns subsidiary, but that's an interest that the third party has in that subsidiary, which is non-controlling. Controls it, the parent, right? That's why it's called non-controlling, because that third party owns less than 50% of that subsidiary. Okay, so let's go through this here now. And keep in mind, it's also part of total equity. It used to be in the mezzanine section, meaning back in the day, you used to have a section for liabilities, then minority interest, and then finally equity. Now all you have is liabilities and then equity with non-controlling interest, part of that equity account. So just something to point out as well. Page 24, we have a column for full goodwill and partial goodwill. The focus, for the most part, is full goodwill, right? There's problems at the end as well, and the problems focus on full goodwill as well, because that's required under US GAAP. If full goodwill is an option under IFRS, so is partial goodwill. But because full goodwill is required by US GAAP, and it's also an option under IFRS, right, that's something you're going to see significantly more than partial goodwill. Because partial goodwill, not only is it not required by US GAAP, but it's also an option for IFRS. It's not even required for IFRS. So you know, a lot less companies will use partial goodwill relative to full goodwill. Okay, but we're going to cover both just so you see how the math works under each. So full goodwill. Full goodwill is calculated as the difference between the total fair value of the target company and the fair value of the target net assets. Now, when we say total fair value of the target company, what we have to do is we have to actually gross up the purchase price to get to 100%, okay, by dividing by the percentage we're acquiring. So let's go through an example. Same as before, but the only difference on this page, page 26, is that you're not buying 100%, but you're buying 80%. Okay, so red buys 80% of blue for $300 million, 50% debt, 50% equity. Well, what does this mean? Well, we're still paying 150 in equity and 150 in debt, but keep in mind, we're only buying 80%. So this is going to alter the goodwill calculation. How? Well, let's go to the next page, 27. If you buy 80% of the target for $300 million, that implies a purchase price of 375 for the entire company. 300 divided by 0.8, or 80%, is 375. Then you have target net assets excluding goodwill of 210. This was just like before. So therefore, deal goodwill is 165. To gross up the purchase price because the net assets are for the entire company, right? The 210. So we have to compare apples to apples. And that's a general concept in finance to keep in mind, that you have to compare apples to apples. You can't compare 300 to 210. That's a disaster because then you're comparing 80% of the company for, you know, with 100% of the company. Okay, I think there's some background noise on someone's end here. Okay, I think someone has some background noise here. Okay, so basically you have to make sure that you're comparing 100% of the target in terms of purchase price with 100% of the target's net assets excluding goodwill. So this way you're comparing apples to apples. So we get 165. Right, so in this case, you end up consolidating, and what happens? You have 165 for goodwill financing, minus 140 for accounting for goodwill, 150 for debt and equity each, minus 250 for the equity as before, because you're wiping out the target equity. But now you have 75 for NCI, which is 20%. That's the NCI stake times 375. So now it balances. So compared to the earlier example where we bought 100% for 300, the difference is here you have an incremental 75 in NCI, which is offset by the incremental 75 in goodwill, right? Because keep in mind in the earlier example from before, if you recall, we had 90 in goodwill, right? Now that 90 went up to 165, so it went up by 75. Well, the 75 in incremental goodwill is offset by the 75 in NCI. So therefore, both sides of the balance sheet went up by 75. Before, remember, we had 1760 on both sides, right? The total assets and total L&E were 1760. Well, now both sides are 1835. Therefore, they both went up by 75. It's because you didn't buy the whole company for 300 million. You only bought, 80% of it. Okay, so therefore, your goodwill went up by 75. And so did your NCI, right? So both sides are now 1835. Any questions on page 28 here?
Did we calculate for the 375 or was it given?
375. We calculated it on the prior page.
Thank you.
All right. Yep. So on the prior page, remember we were saying that you're buying the company for 300 million. Well, 80% of it. So what's the implied price for 100%? It's 300 divided by 80% or 0.8. So that's going to give you 375. So what's 300 divided by 80%? 375. So the idea here is if I buy 80% of a company for 300 million, that's like saying, hey, I'm buying the whole company for 375. Proportionally, it's the same. Okay, questions here, guys. Okay, so now partial goodwill. So partial goodwill, this is an alternate to full goodwill. This is not allowed under US GAAP. It's only allowed under IFRS. Question here, yep.
Yeah, there was a question in the chat. They're asking where does the 150 in debt comes from?
So the 150. So remember how we're financing the deal. We're financing the deal with $300 million, 50% debt, 50% equity. What's 50% of 300? 150. Okay, so that's why it's 150 in equity and 150 in debt financing. Page 26. So that's the problem. But same thing I had a problem earlier. It's 150 in debt, 150 in equity is the financing. Okay, questions here on page 28. Okay, perfect. So now, partial goodwill. Keep in mind, this is an alternative full goodwill. It's not allowed under US GAAP, right? So we're not going to really be focusing on it as much in the problems at the end. You know, we solely deal with full goodwill, but we do want you to be aware of it and aware of how the math works. Okay, so here it's a bit different because we're not grossing anything up. We're saying the deal goodwill, right? That's calculated as the difference between the purchase price paid and the acquirer's share of the fair value of the net assets acquired. Okay, so therefore, what we want to do is we want to figure out what the purchase price is, and then we want to figure out what the percentage that we acquire is times the net assets of the target and subtract those two to get goodwill. So basically what's going to happen is deal goodwill under this method is going to be smaller than the full goodwill method because you're not grossing everything up, you're grossing everything down, if that makes sense. And let's go through an example here. So let's say red buys 80% of blue, same example. But now we are dealing with partial, not full. Okay, now we're dealing with partial, not full goodwill. Okay, I think, can everyone hear me here? Just want to make sure.
Yeah, we're able to hear you. I think it's just sometimes it might just be the internet connection. Your voice will cut in and out, but I don't think it's personally your fault.
Got it. Just let me know. Yeah, if there's something you want me to repeat, just happy to do so. Just let me know here. Okay, so I'm going through this slowly as well. So I'm also pausing a lot just to make sure everyone absorbs the content. So that could be part of it. So I'm not speaking continuously. I am pausing quite frequently just so everyone can fully grasp the material. That's the other thing. So if you hear me for, every now and then just stop talking, that's because I just want everyone to grasp the material. But if there's something that you're missing, of course, or not understanding, of course, again, just ask, and then we can go through it, of course. So just let me know if there's something that's not clear. Okay, guys. So basically, red buys 80% of blue for 300 million. 50% debt, 50% equity. All right. So now we want to calculate under the partial goodwill method. First, deal goodwill. How do we do that? Well, instead of grossing up the purchase price like we did in the prior example to 375, what you want to do is you want to compare 300 to the percentage of the target and assets you acquire. So we're acquiring 80%. What's 80% of 210? 168. Keep in mind, 210, that's the same, math we went through earlier, right? 250 minus 40 is 210. So 210 times 80% is 168. 300 minus 168 is 132. So therefore, the deal goodwill is 132. Okay, any questions here? And keep in mind, this is smaller than what we had earlier, right? Remember earlier we had what, 165? Right, if you go back to we're on page 31. Right, if you go back to page 27, you see how it says 165? Right, on page 31, we get 132. And that's because we're not grossing everything up. So you're dealing with smaller numbers, right? So if you take the difference between two smaller numbers, it's going to result in a smaller difference. So we get 132 here. That's the deal goodwill. Okay, so therefore, here's the consolidated balance sheet under partial goodwill. Essentially, it's going to be 132 in goodwill and then 42 in NCI. Okay, so both sides add up to 1802 in the consolidated column. And you see that NCI is 20% of 250 minus 40, right? Because 250 is the equity, 40 is the goodwill of the target for blue. So therefore, 20% times the difference between 250 and 40 is 42. Okay, so we end up with 42 as NCI, which balances out the fact that goodwill went up from 90 in the first section to 132, which went up by 42, right? 90 to 132 is an increase of 42. That's offset by NCI of 42. Okay, any questions here at all on page 32? Any questions on the partial consolidation balance sheet? Okay, so let's going here now. Let's deal with the income statement. So what does the income statement on a consolidated basis look like with NCI? Let's say that you expect red synergies of 35 million, right? SG&A synergies. There's new debt interest rate of 8%, and there's a marginal tax rate of 35%. What does the pro forma income statement look like? Okay, so go to the next page, and I want you to take a second and think about this carefully, right? So construct a pro forma income statement. I want you to think about this page carefully, and then we'll go through it together. Page 34. You think about the math here carefully. Okay, so let's go through it. So essentially what's going on here is that all the adjustments are actually the same as the other section at the beginning, except for the fact that there's NCI at the bottom, right? So the 35 million in SG&A reduction is the same. The 12 million in incremental interest expense is the same. The tax expense adjustment of 8 million incremental is the same. It's going up by 8 because the 35, remember, the 35 is higher than the 12, right? Therefore, because the 35 million in SG&A synergies results in an increase in tax, and the interest expense results in a decrease in tax, the net impact is a positive 8, increase of tax of 8. So therefore, our profit after tax is 341. But now, what's the new part? We have NCI of 20. Why? Because our non-controlling interest income is going to be 20% of target net income of 98. What's 20% of 98 rounded to the nearest million? 20 million. So we have net income to the parent company, meaning net income to Red Corp of 321. Any questions here on page 340, on page 34? Net income of 321 at the bottom. Do you see that for Red Corp consolidated? That's the parent company net income of 321. Questions here?
Yeah, quick question. So how did you get the 341 for Red Corp consolidated for profit after tax? Because I was adding the 228 with the 98 and I was getting 326.
Well, because if you add, basically ignore investments, right?
Sorry, you skipped for me. Can you say that one more time?
Yep. So if you add the 220 and 98, you're ignoring all of the adjustments, right? Because then you're just taking the standalone income statements, correct?
Correct. Got it.
So the idea is then you're just completely ignoring the 35, the 12, and the 8 in the adjustments column. So just something to point out. Anytime you have any of these type of situations where you're consolidating or you're adding up multiple income statements, you want to add the individual line items like revenue, COGS, SG&A, interest expense, all of those. Anytime you get to a subtotal like gross profit, operating income, pre-tax income, profit after tax, or net income, how do you add? Do you add horizontally or vertically?
Vertically?
Yep. So for gross profit, how do you calculate that? It's 1,300 minus 480, not 600 plus 220. I know it's the same for gross profit because there's no adjustments, but when you're doing the math in Excel, you always want to go vertically for the subtotals. When you get to operating income, 45? No, that's not. Get to operating income in the fifth line, what do? You say 820 minus 290. Does that make sense?
Yep. Thank you so much.
Yep. No, of course. I just want to make sure that's clear. So anytime you have a subtotal, always go vertical. Anytime you have an individual line item like revenue, COGS, SG&A, interest, like that, go horizontal. Because otherwise you're ignoring all the adjustments. Think about it. The red and blue columns are just standalone, right? So if I wanted to calculate Red Corp consolidated, well, if I was just adding everything horizontally, I wouldn't need the adjustments, right? I would just say 228 plus 98, last line, done. But it's not that simple because there's adjustments affecting the line. So to get the net income, the last line at the bottom, on a consolidated basis, you can't say 228.98. You have to say 341 minus 20. Any questions here? Now, here's our base analysis. You guys remember the base analyses from our FSA concepts, but non-controlling interest is another mixed account because the addition to NCI is NCI income and the subtraction is NCI dividends. On the cash flow statement, the NCI income is an add back to operating cash flow, just like DNA or SBC is, right? Depreciation, amortization, stock-based compensation, just like those are add backs to operating cash flow, right? As you know from FSA, so is NCI income. That's an operating cash flow. Well, what's the subtraction here? It's the NCI dividends from financing cash flow. Because one is operating, one is financing. Guess what? This is a mixed account. Okay, just like PP&E that you've seen, just like intangibles that you've seen, and just like retained earnings as well, right? Those are all mixed accounts, so is NCI. So we have to break out the components of NCI into operating and financing. So let's say that the NCI is 20 and let's say Blue pays dividends of 40, well, 40 times 20% NCI is 8 million. So therefore, 20 is added back to operating and 8 is subtracted from financing. Any questions on the cash flow statement impact here for NCI? Remember, NCI of 20, that's not income. Nothing on the income statement is actually, it's not cash. Nothing on the income statement is cash. Keep that in mind, right? Whether it's SG&A, whether it's taxes, whether it's net income, nothing on the income statement is actual cash. That's what we need the cash flow statement to help us with, to reconcile net income, which is a non-cash figure, to a cash figure. Okay, that's the whole point of the cash flow, to understand what the cash movement is, what the cash inflows and outflows are, right? Because the starting point is net income, which is not cash. Questions here on page 36.
Why is NCI after tax?
Yep, so NCI is going to be after tax. That's going to be basically after tax because it's the amount of net income that's attributable to the third party. And because net income is after tax, the NCI is after tax. So what is the NCI anyway? It's the non-controlling interest income, right? So meaning that's the net income of the subsidiary that's essentially attributable to the third party that owns a stake in that subsidiary. Okay, questions here. Remember, net income is post-tax, and that's net income because it's the net income of the subsidiary. That's why it's post-tax. Now, mixed account of full and partial goodwill. Right? Partial was 42. If you remember, those were the numbers we came up with for NCI in this section, right? 75 for full, 42 partial. We added 25 for the income, subtracted 8 for the dividends. Now, every year, we're going to end up with a different amount based on whether we started with full or partial, right? Because the increase and decrease every year is the same. It's just that the starting point is different. So if we started with full, we're going to end up with a higher number than if we started with partial. Okay, questions here? Okay, so now equity method accounting. Okay, equity method accounting. This is how we account for an investment where we own 20 to 50%. Remember, significant influence but not control. Again, significant influence but not control. This is also known as one-line consolidation. Okay, one-line consolidation. Let's go through an example here, but first we have to understand the impact on the three statements. So on the income statement, what we want to do is show a proportional share of the investee's net income. So if I buy 30% of your company, right, 30% of your company, what's going to happen is every year, 30% of your net income will show up on my income statement. Now, is the net income cash? Nope, never. And net income is never cash, right? What's the cash portion? So if you think about it, guys, net income is never cash. What's the actual cash portion coming in? What is that called again? Right, so think about it. Net income is never cash. If I say what's the cash inflow or outflow, depending on what you're referring to, what's the actual cash called that goes in or out?
Dividends?
Excellent. Perfect. Dividends. Very good. Dividends. Yep. So what we want to understand here is net income, right? That's not cash. Dividends is cash. So on the income statement, we show the portion of the net income that's attributable to us, to the investor, but that's not cash. You have to, on the cash flow statement, account for the dividend coming in as well. Okay, and that's what we're saying here on this page. So that's why on the cash flow statement, we have to subtract the equity income and add back the dividends received. The way to think about this is the complete opposite of NCI, right? So when you think of NCI, think of the complete opposite of equity method investment. That's really important to understand. This is the complete opposite of equity of NCI, because an NCI stake represents a third-party interest in your subsidiary, right? It's someone else's stake in a part of your company, right? A part of your subsidiary. Whereas equity method investment is the opposite. It's your stake in someone else's company. Okay, so an equity method investment is your stake in someone else's company. Unlike NCI, which is actually someone else's stake in one of your subsidiaries, right? So they're polar opposites, and that's what initially a lot of people new to this was confused. Okay, and again, you have to think about them as complete opposite, right? One's a stake in someone else's company, another stake in your company, someone else's stake in your company. So complete opposites here. And this is where it takes some time to get used to, but that's why you have to make sure that you go through the problems in the back here. You spend some time going through the slides again as well, just really wrapping your head around this concept. So the equity method, let's do the balance sheet impact. Red buys 25% of blue for $50 million for cash. What does the pro forma balance sheet look like? Well, remember, this is one-line accounting, and what I mean by that is the investment is accounted for in one line called equity investment, or you might see equity method investment as well as the name. So therefore, the cash goes down by 50 and the equity investment goes up by 50. Now, maybe you funded it with equity, maybe you funded it, that's great. Then all that would happen is those lines would be adjusted as well, right? So let's say you funded it with debt. No problem. Then all would happen is you wouldn't have a minus 50 next to cash, you would just have a plus 50 next to debt. And notice you would still balance, right? Because then both sides would be up by 50. But in this case, the equity method investment goes up by 50 and the cash goes down by 50. So however you want to finance it, you're still going to balance, right? Either the cash goes down or the debt or the equity go up. Either way you balance. Or it's some combination, right? Maybe you did 10 in cash, 10 in debt, 30 in equity. However you do it, you're going to balance, right? Because the equity investment is going to offset the financing. Any questions here on page 42? What's the income statement impact? Well, red buys 25% of blue. The only income statement impact here is that we have to account for the equity income at the bottom after profit after tax. So therefore, if you buy 25% of a company, what is the income attributable to red? It's going to be 25% of the 98, which is 25, rounded. You might say, oh, it's not 25. Well, it's rounded. It's 24.5 technically, right? But if you round it, everything is rounded here to the nearest dollar or nearest $1 million. It's going to be 25 million, right? So therefore, the Red Corp consolidated equity income is 25 million, and the net income at the bottom is 228 plus 25, which is 252. Now, 25 million. That increases parent company net income, right? 228 to 252. It went up. But wait a second. As we know, is the equity income cash? So guys, is the equity income cash?
No.
No. What's the cash that comes in? What is that known as?
The dividends.
Boom! There we go, Jaden. Perfect. Dividends. The dividends is what comes in, right? That's the cash. So we have to make sure we incorporate, all of this on the cash flow. Remember, the income statement only shows the income, the net income impact, right? If you want to obtain the true impact, including the cash, then you got to look at the cash flow as well. So here's the analysis. The beginning balance plus the percentage of the net income minus the percentage of the dividends is the ending. Notice it's the exact same thing as for NCI or for retained earnings. It's not any different, right? So we've covered retained earnings in prior sessions. We did NCI earlier today. Well, this is the same concept. Beginning plus net income minus dividends. Right? These are all accounts that relate to equity in a sense. If you think about it, right? They're all equity related accounts. Okay, the equity method investment, yes, it's an asset, but it relates to the equity of another company. The bottom line is they're all in some way, shape, or form related to equity. Okay, questions here? Okay, so blue pays dividends of 40. Now, what happens here? Well, the dividends is what? Remember, what's the equity method percentage? 25. What's 25% of 40? 10, right? So the dividend income is 10. So therefore, at the top, we break it out. We say net income of 252, right? What's 252? That's actually coming from the bottom of page 44, right? The bottom of page 44 is 252. So we start there. We back out the income of 25 because that never actually came into our parent company in the form of cash. Wait, but what did? The 10 did, right? So the 10 you have to add. So we get 238. Now, what's the more common presentation? It's a little tricky, but actually with equity method investments, the common presentation is the net number. The net number is negative 15, right? What's minus 25 plus 10? Minus 15. So the most common presentations at the bottom, we're just taking the difference in the equity method investment or equity income net of dividends, basically. So that's going to be minus 15, right? So what's 252 minus 15? 238. Any questions here on page 46? Guys, questions here. Everyone good?
All good.
Perfect, perfect. So now, what does the analysis look like? Well, the beginning balance is 50, the additions is 25, the subtractions is 10, and the ending balance is 65. Okay, because remember, the additions is 25 in net income, and the subtractions is 10 in dividends. Guys, any questions on page 47? Okay, so now, finally, we're not going to spend as much time on this as the other sections because this isn't something you're going to spend nearly as much time on in banking. You know, if you're going into banking, into private equity, you're mostly focused on A, the consolidation process we covered in the first section, B, maybe equity method investments a bit, right? If you're advising on a situation where there's significant influence involved but not control. But the third case here, the third section involves less than 20% acquisition. Remember one of the first pages up front where we had the split, right, between the different types of accounting. We said more than 50% is consolidation, right, assuming you're achieving control. 20 to 50% is equity method accounting, right, because it's a significant influence but not control. And then less than 20% is a financial investment. Okay, so basically with the financial investment, the way it works is there's three categories. There's held to maturity trading or available for sale. And the accounting for each you can see on page 50. So the idea here is that regardless of the classification, dividends and interest income and any realized meaning after you've actually sold the investment, realized gains and losses, they're going to be recognized on the income statement. But what about unrealized gains or losses? Well, that depends. Look at the different categories. In the held to maturities case, you have debt securities you're intending on holding till maturity. So in that case, you're reporting on the balance sheet the amortized cost, right? So any changes in market value are ignored. Okay, therefore, you only recognize the gain or loss upon sale. Trading securities, because the idea here is you're intending on profiting off of them in the short term, constantly, you know, buying, selling, buying, selling. You're reporting on the balance sheet the fair value. And then any unrealized gains and losses, meaning any, you know, mark-to-market gains and losses, just day to day, you know, month to month, you're recording them on the income statement, even prior to, you know, ultimately selling the investment. And then available for sale securities is kind of a hybrid in a sense. It's in the middle of those two. Right? These are not expected to be held to maturity, nor traded in the near term. So they're going to be reported on the balance sheet at fair value. But the unrealized gains and losses are reported in something called OCI, or other comprehensive income, right? So we've talked about other comprehensive income in prior sessions briefly, but the idea there is that's going to reflect items like this, like available for sale security income and losses, right? Which are not going to be on the income statement, which bypass the income statement. Remember, other comprehensive income is not something we're in the business of projecting in a model, but that arises due to other items, like items that bypass the income statement, like gains or losses on available for sale securities. There's, you know, pension related items, there's foreign exchange or currency translation related items. The bottom line is OCI includes a number of things that we're not in the business of projecting. Okay, any questions here, guys? Yeah, and again, this isn't something you're focusing in on day in and day out. Okay, what you're focusing on is primarily the consolidation process we went into in detail up front for the majority of this session, and maybe the equity method investments a bit. But you're not focusing mostly on this here, because this only applies if you buy less than 20% of a company, right, for investment purposes. Any questions here on any of these categories? Consolidation, more than 50%. Equity method investments, which arise when you buy 20 to 50%, and then a financial investment, which arises when you buy less than 20%. Any questions on each of these three categories? Okay, so that basically that concludes this this session here, guys. Any questions at all? Any questions on any of the content that we've covered here? Julius, Jaden, Jamie, Christian, Carlton, everyone in good shape? Nicholas, Sebastian, Valentina, Damian, Alexander, guys all good? Nicholas, Ian, Eduardo?
I'm good.
Yep,
Okay,
I'm good.
perfect.
Thank you.
Just want to make sure. Again, we're here for you guys, so just want to make sure if you have any questions, you know, please reach out at any point, and you know, just make sure that you're taking advantage of all the material that we give you. We really want to make sure you guys all do well, you know, going forward, your position for success, and that's what the purpose of all of these sessions is for. Okay, so again, if you need anything, please reach out to Pillars here, and otherwise, I will, you know, hopefully we'll see you on a subsequent webinar. And again, just keep practicing, right? Just go through the slides. There's a lot of problems in the end. We always give you problems. You can easily, you know, kill 3-4 hours going through the problems at the end. I would definitely spend the time to do that, you know, to really solidify your understanding of the M&A accounting. Okay, everyone, thanks again for attending. If you need anything, reach out. Otherwise, hope to see you guys on a future session. And hopefully you guys are, you know, getting the most out of this and learning.
Thank you. Have a good rest of your day as well.
Thank you.
Yep, have a good day, everyone. Yep, take care.
Thank you.
Yep, have a good day, everyone.